Why do people invest in a stock? Like, what makes a stock go up if no one invests? So I've been investing for 5 years and I still don't understand the value of investing in a company. Let's say no one invests on company XYZ. Every year company X's profit margins double but no one invests in them. Will the stock go up? Like, do investors make the price go up, or can the company's earnings performance make it go up? I don't understand what makes it physically go up. What's the intrinsic value of a stock? Depends what you mean by worth. If nobody buys the stock, then its resale value $0. But the person who owns it will get dividends, profits from the company's rapidly doubling margins. So the owner is still pretty happy in that scenario. If a supermarket sells an apple for $1 but no one buys it, is it worth $1? Stock is literal ownership in a company. As an owner of the company, you could get dividends, a payout if the company is sold or goes private, and higher stock prices if the company performs well. A company that's doing well has more demand for its ownership than a failing company. Discounted cash flows. To be extreme, if you make an investment of $100 and 10y later, you get an annual checks for $500. No way are you selling it for $100 anymore. Companies themselves can increase dividends and/or do share buybacks. From the 1940s until early 1960s, American stock market was a very much forgotten place, and many companies were sitting on assets that greatly exceeded their market caps. Warren Buffett happened to make his first fortune identifying these companies, accumulating their shares, often very illiquid and being held in paper form by individual households in great secrecy, and forcing company management to return capital to shareholders. In the end, it boils down to the ROI. No one is going to let a safe income trade for too big of a discount. It's what makes growth and tech stocks so risky. If for some reason they stop growing and don't have a significant income to support their valuation, they crash hard. Stocks go up and down because of more share buys or sells. Nothing else matters. There could be incredibly positive news, but if there are no buyers, the equity will not move higher. Victory hand, light skin tone. If you own shares in a company and suppose there is no one in the world who wants to buy them, its value is not zero, because the company owns assets, real estate, machinery, and even cash. If the company decides to stop working and sell them, it will distribute that amount to the stockholders. There is also the value of the annual distributed profit. The important thing is that the company is profitable and has no debt. Every time you buy a stock, someone is selling a stock. So if you don't buy it, the last guy still owns it. Price goes up because you bought it at a higher price. Judging by your previous posts, put your money in a high-yield savings account. Delete Reddit. Take a course in finance. Profit. Imagine if nobody wanted to buy Apple and you can just scoop up 100 of the shares for $1. The company has billions of assets and cash that you would have purchased for free. Balance sheets create inherent value. Demand versus supply. Stocks are sold to investors. Those investors determine the price of the stock. If the company is doing a bang-up job and creating a greater and greater valuation of the company, then the stock is considered to be undervalued. Value investors low undervalued stocks, as over time the stock price typically reverts to its fair value price. If there is great speculation that the company is going to be a highly valued company, people buy the stock, driving the price to overvalued. And again, stocks revert to their fair value over time. I think Matthew McConaughey in The Wolf of Wall Street has the best explanation. It's ultimately about belief. Just like with money, The market believes the value of a share of XYZ is worth more or less, based on whatever factors buyers and sellers consider most relevant. If nobody invests, the stock price will not move, but if you could buy all of Apple for $1, would you be like, nah, the stock will never go up? As a shareholder, you have legal ownership of the company. If a company's public price gets too disconnected from its fundamental value, someone is going to just buy the whole damn thing via a hostile takeover or a private bid. The fundamentals matter. The reason I ask this is because I don't know why AMC keeps going down so much when the company just became profitable. Taylor Swift will bring in $6 billion revenue with her contract to AMC. And now Beyoncé is doing a contract with them as well. Keep in mind AMC is only a $1.5 billion company. And these contracts are going to bring in billions. Also, Walgreens is a $20 billion company and they make $35 billion revenue a quarter, yet it keeps going down. Why don't people invest in these companies? The inherent value of the proportional ownership interest in the underlying company. Changes in balance sheet. Theoretically, you are right. Stocks are Ponzi. If new buyers don't come in paying more than you, companies don't go up in price. However, if a company performs well and is attractive, there will always be new investors ready to buy it. The rich need a place to put all their money. Follow the rich. Earnings is what makes a stock go up. It's a mix of value, profits, growth, industry, etc., and investor interest. Take a private company going IPO. Where does that valuation come from? It comes the company's assets, growth potential, investor interest. People want to be part of success. Successful and hopeful businesses issue stock. People buy stock to share in the hopes and success. X200B. Is that too philosophical for you? Well, if no one invested in the company, you are right, the stock would stop going up. But if the stock stopped going up and earnings continued to go up, then the board would just say, well, no one is buying to stock to make it go up, so our wallets aren't getting fatter. So I guess we might as well pay ourselves a fat dividend to line our pockets, and then the stock would go up. Because now the stock would be paying a massively outsized dividend compared to the share price of the stock. Conceptually, stocks go up based on the future PE multiple and future earning discounted for inflation and federal funds rates. When inflation is high and yields are high, money leaves the market on a macro level. Mainly because $1 EPS is discounted when inflation is high and higher bond yields lead to competitive alternatives to dividends. TLDR, a stock goes up based on its future earnings and earnings growth. In theory, it's the discounted value of future cash flows, dividends issued by the stock. However, the market often gets divorced from that theory. Depending upon your strategy, that can mean it's a good time to buy or sell. Most intro finance or valuation courses cover this if you're interested in looking into the details further. The intrinsic value is ultimately the yield, but there are all these investors in between. Most investment are tied into stocks. If you do 401k, etc., it's usually growth stocks mix with bonds and cash. So regardless if you do everything on your own or not, you're in the market. If no one invests but the company makes more and more money, then your dividends, potential future dividends, will increase, thus your return on investment increases. That's why people will buy the stock in order to get a part of this pie, driving the price of the stock up. A stock is a fraction of the company's market value. Company's value is determined by future earning expectations. Without these companies, we wouldn't have a stable planet economically. Isn't a share a percentage of what the company is worth? So if more people buy Microsoft software, The share will go up because the company made more money. I could be wrong, but that's my guess.